Welcome, everyone, to a brand new explainer. Today, we're looking at a truly fascinating picture, the August 2026 global metals market. Right now, we are staring down a profound, almost unprecedented macroeconomic mystery. Across the globe, we're seeing some metals aggressively hitting all-time historic highs, literally touching the sky, while simultaneously, others are quite literally collapsing and digging themselves deep into the earth. So why is this happening? What on earth is driving this incredible divergence in the very materials that build our modern world? Well, we're going to unpack exactly that.
Okay, let's dive right into the agenda. First, we'll map out this polarized picture. Then, we'll look at gold and silver front-running the Fed, followed by copper acting as the 21st century oil. Next up, we'll examine the pain in the steel and real estate sectors. And finally, we'll wrap things up with a summary of the macroeconomic risks.
Section 1. The polarized picture and extreme market divergence.
Money is no longer flowing evenly across the board. Instead, in the tech and future metals sector, we are just seeing a sea of green. Notice the incredibly strong upward momentum for palladium, lithium, copper, aluminum, and of course gold. These assets are sucking up all the available cash in the room. But here's the real kicker. They are no longer being priced based purely on traditional economic cycles. Instead, they're being valued on future technological expectations, things like the massive energy infrastructure required for AI, microchips, and electric vehicles, alongside nations totally reshaping their foreign reserves.
Now, what's really interesting here is the brutal contrast. Traditional construction and industrial metals are flashing bright red. Sectors like titanium and platinum are pulling back, and the broader steel and iron sectors are just bleeding out. It reflects a pretty harsh reality. The global economy is absolutely not experiencing a synchronized boom. The traditional foundation is actually struggling significantly, even while the tech sector flies high.
Let's pull these two extremes together into a unified snapshot of the August 6, 2026 futures market. You've got gold sitting at a staggering $4,330 an ounce on the COMEX, with huge upward momentum driven by money shifting out of bonds. Silver is holding super steady above $62. Over on the London Metal Exchange, copper is having a solid breakout at $15,000 a ton thanks to AI and grid demands. Palladium jumped over 4% on the NYMEX due to physical supply fears, trading around $1,380. And then, dead last in red, steel rebar on the Shanghai Futures Exchange is bottoming out around 3,006 Chinese yuan per ton. It is literally a market cut completely in half. Let's break down the green side first.
Section 2. Gold and silver, front-running the Fed. Punching in right here, $4,330 per ounce. Just a remarkable, historic milestone for gold. Now, typically, you might think this is purely a panic response to war, and sure, geopolitical tensions, like what we're seeing around the Strait of Hormuz, are definitely causing investors to reprice risk. But our source data suggests a bit more nuance. The real engine driving this specific surge is capital actively abandoning traditional bonds.
And right alongside it, silver has climbed to a really impressive $62.10 per ounce. Silver is so fascinating right now because it's riding two different waves at the exact same time. It has that precious metal status that makes it a safe haven, just like gold, but it's also being propped up by undeniable, surging industrial demand for all that new tech infrastructure we mentioned earlier.
As you can see with the COMEX gold futures for December 2026, there is an aggressive near vertical spike surging right past the $4,300 mark. That upward action represents an absolute tidal wave of speculative capital entering the market. Folks aren't just buying physical gold to hold in a vault somewhere, they're buying futures contracts, which means they are making massive forward-looking bets. But what exactly are they betting on?
Well, our source uses a brilliantly vivid Vietnamese metaphor to describe this behavior. Come den chai chik oto. Literally, it translates to running with a lantern in front of a car. In financial terms, we call this front-running the market, or in this specific case, front-running the Federal Reserve. These investors aren't just buying out of geopolitical fear. They're making an aggressive, unhedged bet that the Fed is about to drastically cut interest rates. They're basically trying to sprint out ahead of the headlights before the car even arrives.
So the crucial point is this. Because current prices reflect so much optimism and so much speculative expectation, this market is incredibly fragile. It's a house of cards built on rate-cut dreams. If we get even one unexpected inflation report that shows prices ticking back up, it could instantly shatter those hopes for lower rates. And if that happens, the people who ran in front of the car are going to get absolutely flattened by a brutal, sudden wave of profit-taking.
Section 3. Copper, the 21st century oil. Let's shift our narrative away from speculative central bank bets and look at hard, undeniable physical demand. I want to really emphasize this powerful analogy from our analysis. Copper is the oil of the 21st century. Seriously. If gold is the undisputed king of financial safety, copper is the essential lifeblood of the new digital era. You simply cannot build the future without it.
And the futures markets validate this narrative perfectly. On the London Metal Exchange, copper has broken the historical $15,000 per ton barrier. In fact, on the Shanghai Metals Market benchmark, it even hit 16 grand. This isn't just a speculative bubble, this is a historic milestone driven by actual physical necessity in the real world.
And this brilliantly illustrates why it's happening. A stark structural deficit. On one hand, you have this insatiable demand for constructing gigantic AI data centers and upgrading entire national electrical grids to handle them. On the other hand, you have incredibly sluggish new mine supply. I mean, it takes years, sometimes over a decade, to bring a new copper mine online. This creates a severe structural deficit, putting an incredibly solid, immutable price floor under copper. The demand is here today, but the new supply is years away.
If you want real-world proof that this isn't just a theory, look at the financial data from Arubis, Europe's largest copper refiner.
On this very day, in August 2026, they reported earnings that completely crushed 9-month profit expectations. They didn't just beat the estimates, they raised their full-year profit forecast straight to the ceiling. This is concrete, undeniable proof from the ground floor that the tech sector's massive appetite for copper is translating directly into booming real-world industrial consumption.
Section 4. Steel and Real Estate Pain.
Let's move over and see how this builds a larger picture. We're now leaving the high-tech boom behind and entering the dark side of the traditional economy. In stark, depressing contrast to everything we just saw, steel rebar on the Shanghai Futures Exchange is collapsing down to around 3,006 Chinese yuan per ton. While copper and gold are shooting for the moon, steel is basically falling off a cliff. This is the darkest spot of the global market right now.
Why is this happening? Well, it's the cascading, direct result of China's prolonged, seemingly endless real estate crisis. There is severe stagnation in civil construction demand. Buildings simply aren't going up at the pace they used to, which means local steel mills are suffering rapidly ballooning financial losses. They're churning out a material that the market currently just does not want. This proves beyond a shadow of a doubt that the global economy is far from a synchronized boom. It is highly, highly fractured.
Section 5. Summary and Risks. Let's synthesize these completely different market realities into a cohesive takeaway.
Our source poses a direct question to consider. Is this market for FOMO? You know, the fear of missing out. While the upward trends for gold, silver, and copper are extremely strong right now, and the buyers are firmly in control of the game, blindly chasing these historical highs is incredibly dangerous. You are entering a market that is already priced for perfection.
You absolutely must beware the power of a single headline. In a market this highly strung, a single message, report, or even a tweet regarding the Federal Reserve's intentions could trigger instant 100-point pullbacks. Strict, disciplined risk management isn't just recommended right now, it's a requirement for survival. So as you analyze these soaring metals, you really have to ask yourself, are you investing in the undeniable physical reality of copper's tech-driven future, or are you just holding a lantern running in front of the Federal Reserve's car, hoping they don't hit the brakes? It's a fascinating landscape, and one we'll be keeping a very close eye on. Thanks for joining me on this explainer, and keep learning.